Hello, I'm Anthony Saglin-Benny, Chief Market Strategist at Ameriprise Financial. Welcome to this episode of Ameriprise Talks, where our quarterly panel of experts share perspectives on the markets and economy. 2025 was a year of deep lows and record highs for the stock market as economic dynamics evolved and AI optimism continued to capture investors' attention. Overall, the 2025 landscape was shaped by ever-changing tariff developments, inflation concerns, enthusiasm for big tech, a softening job market, and interest rate cuts by the Fed in the back half of the year. Through it all, however, the market and economy remained remarkably resilient. To help you make sense of what could be in store for 2026, I'd like to introduce Russell Price, Chief Economist at Ameriprise, and Brian Erickson, Fixed Income Strategist at Ameriprise. Thank you all for joining me. Russ, I'd like to start with you. What's your overall outlook for the U.S. economy in 2026? Specifically, can you touch on the impact of tariffs and provide forecasts on inflation and the jobs market?
Well, Anthony, we think 2026 could be a pretty good year for the U.S. economy. We should have entered the year with fairly good momentum, and consumers and businesses are generally in good financial shape. By that I mean consumers have relatively low debt burdens in aggregate, and businesses' balance sheets are in generally good shape as well. Overall, we project real economic growth this year, that is growth without the artificial boost of inflation, to be about 2.5%. That would be modestly better than 2025's projected rate of about 2.3. Of course, there will be factors that influence activity along the way, some of the most prominent of which should come in the first half of the year. In the first 6 months, consumer spending power should see a boost from lower taxes or larger tax refunds, with the elimination of taxes on tips and overtime, while most seniors should see a benefit from an added $6,000 tax deduction. The income-boosting benefits of these provisions, however, should be at least partially offset by higher health insurance premiums and more stringent enforcement of student loan repayments. Beyond these specific issues, we believe inflation should slowly subside in 2026 after peaking in the first quarter of the year. We project a peak consumer price index rate of about 3.2% in Q1, falling to about 2.2% by year end. That should provide Federal Reserve officials with room to consider further interest rate cuts, which would make business investment and potentially home sales more attractive. At the top of our list of risks, however, is the job market. New hiring essentially stalled last year, not long after the administration announced its large-scale tariff plans. For the most part, however, we believe the tariffs have been economically manageable, and the pace of growth has held up well. As businesses become more acclimated to the tariff situation and related economic fears diminish, we believe hiring should slowly gain traction throughout the year. So, Anthony, let's bring the conversation back around to markets. 2025 was a year of impressive gains for stocks, thanks to big tech and investor enthusiasm for artificial intelligence. Do we expect strong gains to continue, and should investors be worried that stocks may be overvalued?
You're right, Russ. Last year was a pretty impressive year for stocks. Despite some headwinds and volatility in the first several months of 2025, stocks spent most of last year hitting new highs. Notably, the S&P 500 index recorded its third consecutive year of double-digit returns in 2025, led by big tech and artificial intelligence stocks, amid a surge in AI spending, growing AI adoption across consumers and businesses, and strengthening profit trends in the technology sector. This year, continued secular AI tailwinds, potentially broader profit growth across the S&P 500, and firm economic conditions, as you highlighted, Russ, should provide an opportunity for major stock averages to build on their gains over recent years. However, at current valuations and elevated expectations for this year, continued earnings growth will likely need to drive stock prices higher in 2026. In our view, one of the single largest factors that could influence overall U.S. stock benchmarks this year will likely be investors' continued appetite to allocate toward AI-related growth areas. Entering 2026, concentration risk remains a key concern in our view. The top 8 tech companies in the S&P 500 now account for roughly 40% of the index's market capitalization, more than double the roughly 15% share commanded by the top 8 names a decade ago. Thus, where big tech goes from here, so too may go the broader market. As a result, the forward price to earnings multiple of the S&P 500 sits nearly 30% above its 15-year average. However, while stock valuations are elevated at the aggregate level, much of that valuation premium comes from mega-cap technology companies, which continue to show strong profit and cash flow generation. In the quarters ahead, AI-related companies will likely need to rationalize their capital expenditure efforts and demonstrate continued revenue growth to justify that investment. Although we expect periods of market volatility in 2026 as investors sort through these evolving profit dynamics, we believe big tech's secular drivers could continue to be a source of strength for major benchmarks this year. Bottom line, following 3 years of very strong, very concentrated returns across major U.S. stock averages, we believe investors should be prepared for a range of stock, economic, and policy outcomes in 2026. And while investor expectations and valuations are relatively high entering the new year, leaving little room for error, we believe the hallmarks of a resilient consumer, continued AI tailwinds, and still favorable investment conditions provide healthy opportunities ahead. With that, I'd like to get Brian's perspective on fixed income. Brian, let's discuss interest rate cuts. As rates trend lower, what bonds and other fixed income opportunities may investors want to consider?
Thanks, Anthony. The Federal Reserve has shifted from its aggressive stance against inflation in 2023 and 24 toward a more neutral posture. Against the economic backdrop Russ outlined, we expect inflation to continue easing after the first quarter of 2026. We forecast that this environment could allow the Fed to reduce policy rates by 0.5% later this year. While the Fed's dual mandate balances inflation and employment, labor market dynamics are now drawing a greater attention due to the limited job growth. Looking back at 2025, the Bloomberg U.S. Aggregate Index delivered a 7% total return, the strongest annual performance since 2020. The 10-year Treasury yield ended the year at 4.17, down about 40 basis points from where it started the year, with the overall Treasury curve steepening. For this upcoming year in 2026, we forecast a modest decline in 10-year Treasury yields again, alongside anticipated Fed rate cuts, a similar backdrop to what we saw last year. Falling yields enhance price returns, in addition to already attractive coupon income for high-quality fixed income. Cash and floating rate investments likely underperform as the Fed continues to lower short-term yields. With valuations stretched across some broad asset classes within the broader rate cycle, Fed policy continues to support healthy yield levels across treasuries, investment-grade corporates, and municipals. For investors considering portfolio rebalancing or incremental allocation, current bond yields offer an attractive entry point.
A big thank you to Russ and Brian for their thoughtful commentary, and to you, our clients and viewers, for joining us. At Ameriprise, we're committed to giving you the information you need to help make more confident financial decisions in any market environment. For additional timely perspectives from the Ameriprise Investment Research Group, or to explore how these insights apply to your portfolio, connect with your Ameriprise financial advisor.